and you wait for the FANG stocks and the big consumer discretionary weights to get back in gear, and you kind of like, focus on the overall market. That's not going to be a lot of fun right now. The better game to play is to ask yourself, if we're really going into a recession, why is every industrial stock making either a 52-week high or an all-time high? Why are international stocks doing so well? Why are there companies that are doing their own thing and not sitting around waiting for Apple and Amazon to bounce? That's the more interesting game. And I got to tell you, as an older person, which I think I am now, I'm not sure.
No.
We have many disadvantages. One of the advantages that we have is we remember these stocks. Younger investors have no idea what any of these companies, industrials, materials, they're not on Robinhood. The media has covered technology and consumer discretionary ad nauseum for 10 years, and with good reason. Those were the biggest stocks doing the most and releasing products, et cetera, et cetera. That's also where Wall Street raised the most capital into anything related to tech, media, telecom. That's what everyone follows. But let me show you a couple of charts, because this is where the puck is going, and this is where I think our viewers need to start learning some new tickers, for God's sake. Take a look at Russell 1000 industrial companies making 52-week highs in the last 2 weeks. There are so many. I'm just going to give you a couple, and we'll see how fast Vin and Patty are on the trigger. Take a look at Clean Harbors, CLH. This is a $7 billion market cap. The stock acts like a wildebeest. It does not care. It does not pay attention to what's going on in the S&P. Ingersoll Rand, IR. Take a look at this platypus making a new year high. ACOM, ACM. Look at this chart. There's nothing. They broke in the last tackle. There are no sellers. There are so many examples of those. Parker Hannifin, PACCAR, Rockwell Automation. These are the stocks. Don't worry about 25 basis points, 50 basis points.
So what's the message to you?
I just gave it to you.
And to our viewers in those moves? What's that?
The message is learn a new game. The other game, the FANG game, is boring. That's not Wu-Tang right now. This is where money is being made. These are the new stuff. And here's why. And actually, Savita at Bank of America did a really good piece on this. Focus on industries that have been starved of capital for the last 10 years. Energy, obvious. Industrials, manufacturing. These are not areas where Wall Street has raised $1 trillion. And as a result, we've got shortages. We've got more demand than there is supply. There's an energy transition story here that underlies the whole thing. It's not reliant on the Fed. There's just a need for the products these companies make, and they're cyclicals. And I know it's counterintuitive. Why would I buy cyclicals if the economy is slowing down? Well, here's a question. Is it? Like, is the whole economy slowing down, or is Netflix subscriber base slowing down? So that's what's happening, and I think we should be pivoting the types of stocks that we talk about here because of that.
Jimmy, it's a more selective game, perhaps, that you need to play. Maybe that's the overriding message in what Josh brings us. But, I mean, the jury is still out as to whether the economy is going to slow more dramatically than it has. Jury's still out as to whether we're going to have a recession or not, and whether those stocks that Josh just showed, which were all moving higher and certainly seem to be getting a little bit more of a lift as you guys were talking about them, whether those are going to be lasting places to make money. We'll have to find out.
There's always a question, Scott. The answer is never 100% clear. I agree very strongly with what Josh said. It's consistent with something I've been saying for about 1.5 years now, which is that the market is going through a transition in leadership from growth to value. Value sectors, traditionally industrials like Josh was talking about, energy, materials, financials. And you know why. You know my reason why. It's supply chain onshoring and infrastructure spending. It's coming home to roost, and it should, and it's going to last for a couple of years. It's not just that these stocks are cheaper. It's not just that they've been unloved. It's where the actual economic growth is poised to come from for at least the next 2 years. Doesn't mean that technology is dead and going to go down, but it does mean that it's not going to be the leadership. So I agree with what Josh said. And as far as the market overall, for those people who are fixated on that, I think we've got to take the experience that Josh was talking about and use that to gain some perspective. We've had 2 weeks of the markets being wobbly. Why is that? It's because of January economic data that gave a hint that maybe inflation is not going to come down in a straight line. Guess what? Nothing ever moves in a straight line. You had 3 great months of inflation reports. You had one month, January, where it blips up. And let's see what February brings. We got to see what February brings. That's another 3 weeks of waiting.
It's also the idea that the economy is as strong as you have suggested that it is. And that's a two-edged sword, of course, because, yes, you like the fact that the economy is as strong as it is, but it only keeps the bullards of the world talking about how high they need to take rates and maybe how long they need to keep them there. It only keeps those projections, Jimmy, of further rate hikes, adding another one in June. That's the other part of the story.
I like what you just said, Scott. It is a two-edged sword. So you got to pick which side of that sword you're on. You have to, okay? You can't just hang out in the middle. I guess you can, but I'm not going to do that. People know me, right? And on that two-edged sword, I will take economic growth. I will take labor market strength. I will take financial system stability all day long. 5 3/8, whatever. Is that much different than 5 1/8, which is what the market at least has priced in? To me, it's really no difference.